The Federal Reserve's latest interest rate cut presents a market paradox. Historically, such monetary easing has been a catalyst for risk on assets, with investors flocking to alternative stores of value like cryptocurrency in search of yield. This time, however, the anticipated rally has conspicuously failed to materialize. While traditional equity indices, exemplified by the S&P 500, have surged to new highs on the news, the crypto market remains in a state of perplexing stagnation. This divergence is not a minor technical disconnect. It is a powerful signal that the old playbook is broken and that a new, more formidable force is currently governing digital asset prices. The immediate simplistic explanation points to ingrained market psychology, specifically the anxiety tied to Bitcoin's well-documented 4-year halving cycle. Yet, while this narrative provides convenient cover, it fails to account for the magnitude and specificity of the current lag. A deeper, more structural analysis reveals that the primary anchor holding crypto back is not cyclical fear, but systemic regulatory uncertainty. The market is not merely pausing, it is holding its breath, waiting for the other shoe to drop from Washington, D.C. This uncertainty has crystallized around a single piece of proposed legislation, the Clarity Act. Far from its promising name, the act represents a looming specter of profound change. Its progression through Congress is not being viewed as a path to legitimate oversight, but as a potential vehicle for restrictive measures that could fundamentally reshape the decentralized finance ecosystem. The core fear is that the bill, in its final form, could enact provisions that severely limit innovation, impose burdensome compliance costs, or most critically, challenge the very operational models of DeFi protocols, such as the ability for stablecoins to generate yield. This regulatory overhang creates a wait-and-see paralysis among both institutional capital and seasoned retail investors. Why allocate significant funds to a market that might be on the cusp of a hostile regulatory redefinition? The opportunity cost of missing a short-term pump is perceived as far lower than the existential risk of investing right before a damaging law is passed. Consequently, capital that would typically flood into crypto on a dovish Fed signal is instead sitting on the sidelines or diverting to less ambiguous traditional assets, no matter how overextended they may seem. Furthermore, this dynamic shifts the market's center of gravity. The primary driver of price action is no longer the Fed's balance sheet or inflation data in isolation. It is now the day-to-day political calculus on Capitol Hill. Every committee, hearing, every draft amendment, and every public statement from key senators carries more immediate weight than Jerome Powell's press conference. This injects a new layer of complexity and unpredictability into crypto investing, one that traditional macroeconomic analysts are poorly equipped to handle. In essence, the market is sending a clear message. Monetary policy has been temporarily superseded by regulatory policy. Until there is genuine clarity, whether favorable or unfavorable, the crypto market will likely remain in this muted state, its tremendous potential kept up not by its own technology or adoption metrics, but by the slow-moving machinery of legislative risk. The Fed cut rates, but for crypto, the more relevant rate is the speed at which regulatory uncertainty is resolved. Currently, that rate is far too slow for the market to breathe freely and resume its alignment with broader macroeconomic trends. While headline interest rate cuts grab the media's attention, seasoned market participants know that the true engine of modern asset prices often runs on a different fuel: central bank liquidity. The most consequential takeaway from the latest Federal Reserve meeting may not have been the quarter-point reduction in the Fed funds rate, but the subtler Croton operations on the central bank's balance sheet. These operations are being interpreted by a growing segment of analysts as a form of stealth or trickle quantitative easing, a crucial nuance that could prefigure a major pivot for risk assets, including cryptocurrency. To understand this, we must distinguish between the Fed's stated tools. The headline interest rate is the price of money. Quantitative easing in its classic form is about the quantity of money. It involves the central bank creating new bank reserves to purchase long-term government bonds and other securities, directly flooding the financial system with liquidity. suppressing long-term yields and pushing investors out the risk curve into assets like stocks and crypto. The current operation is a procedural cousin, but with a distinct character. The Fed is systematically buying short-term treasury bills to manage banking system liquidity and prevent overnight lending rates from spiking. Technically, because the Fed is creating money to purchase assets, this meets the textbook definition of key. However, the scale and the chosen instrument, short-term debt, make it a muted, deliberate version of the policy. This trickle key is profoundly significant for several reasons. First, it represents a de facto pivot from quantitative tightening QT. For months, the market feared the draining of liquidity as the Fed reduced its balance sheet. The shift to consistent monthly purchases, even of short-term paper, signals that the tightening cycle is conclusively over and a new phase of liquidity provision has quietly begun. This changes the foundational backdrop for all speculative markets. Second, it creates a psychological and mechanistic floor under asset prices. The constant, predictable injection of tens of billions of dollars each month provides a baseline of liquidity that supports financial institutions and market-making activity. For crypto, a market perpetually sensitive to liquidity conditions, this steady drip is akin to a life support system, potentially preventing deeper drawdowns even in the face of negative news. However, the script introduces a critical cliffhanger. This is not yet the main event. The real market trigger, the switch that could ignite a broad-based risk-on explosion, would be a shift from buying treasury bills to buying longer-term treasury bonds. Such a move would constitute unambiguous, full-throttle key, aimed directly at lowering long-term borrowing costs and signaling intense, prolonged support for the economy. The current stealth key is the preparatory stage, the central bank testing the waters and managing systemic plumbing issues. Therefore, the strategic implication for crypto investors is to monitor the composition of Fed purchases, not just their existence. The $40 billion monthly pace in T-bills is a supportive tailwind. A future announcement to include 10-year notes in that buying program would be a hurricane-force tailwind. The market is currently trading on the recognition of this supportive drip. The next major leg up will likely be catalyzed by the market's anticipation of, or reaction to, the Fed opening the liquidity valves fully. In this environment, "Don't fight the Fed" still applies, but the mandate is now to listen carefully not just to what the Fed says about rates, but to what it does with its balance sheet. The stealth has begun. The market is now watching for the signal to attack. The script crystallizes a profound and widening schism in financial analysis. What is the primary driver of market valuations in the current era? This debate is framed through two opposing heavyweight perspectives, each offering a radically different lens through which to view the future of crypto, tech, and risk. The orthodox Fed-centric view, liquidity as the ultimate catalyst. The first and more traditional camp operates on a fundamental axiom: central bank liquidity is the single most powerful determinant of asset prices. Proponents of this view, often macro analysts and traders, parse every nuance of the Federal Reserve statements and balance sheet operations. Their thesis is mechanistic and compelling. When the central bank injects liquidity, whether through lower interest rates or asset purchases, it increases the supply of money chasing a finite pool of financial assets. This excess capital has nowhere to go but into riskier investments, inflating the prices of stocks, speculative tech, and cryptocurrencies. From this perspective, the Fed's current stealth key is not a minor detail. It is the core bullish signal for the coming months. The debate isn't about if this liquidity will boost markets, but when and how powerfully. Crypto, as the most volatile and liquidity-sensitive major asset class, is seen as a primary beneficiary in this scenario, destined to rise on a tide of cheap money irrespective of its internal development. The heterodox, structural view, questioning the foundations in stark opposition, stands the second camp, represented in the script by the voice of Steve Eisman. This perspective argues that the Fed's actions, when merely tinkering at the margins, are largely background noise. The true market-moving forces are secular structural shifts that redefine value creation itself. Here, the Fed-centric view is seen as myopic, obsessing over the weather of liquidity while ignoring the changing climate of technology. Eisman's warning pivots to artificial intelligence. He posits that the entire stratospheric valuation of the tech sector, a key correlate and often driver of crypto sentiment, rests on a foundational assumption that the capability of large language models will continue to improve at an exponential or rapid linear pace. If this assumption cracks, if evidence mounts that we are hitting a plateau of AI capability, as suggested by debates around incremental improvements from GPT-4 to GPT-5, the implications are catastrophic. The AI bubble would not gently deflate. Its core justification would vanish, potentially triggering a repricing cascade reminiscent of the 2008 mortgage crisis, which was also predicated on a single false axiom: housing prices never fall. The irreconcilable conflict and its stakes. This is not a minor disagreement over timing. It is a clash of fundamental worldviews. The liquidity argument is about financial mechanics. The structural argument is about technological reality and its economic value. For a crypto investor, this debate dictates strategy. Adhering to the liquidity view means positioning for a near-inevitable pump from Fed actions, making portfolio decisions based on monetary policy forecasts. Adhering to the structural view demands a deep, skeptical analysis of AI progress, tech earnings, and real-world adoption, with the understanding that a crisis in tech could drown crypto regardless of how much liquidity the Fed provides. The script's narrator ultimately sides with a modified version of the structural argument, believing in AI's long-term transformative power while acknowledging a coming shakeout among AI firms. This leaves the viewer at the heart of the modern investor's dilemma. In a world of complex interdependence, does one bet on the enduring power of central bank money, printing, or on the fragile, unproven trajectory of a technological revolution? The market's next major move will validate one of these opposing theses and brutally invalidate the other. The narrative around Ethereum is undergoing a critical evolution. It is no longer sufficient to frame its potential merely as Ethereum doing Ethereum things or as a simple altcoin rotation. The next major capital cycle in crypto may therefore see capital flow not just into crypto, but specifically through and into the Ethereum ecosystem, making its potential rally distinct and fundamentally supported. The script pivots from complex monetary policy and market structure to sound a stark, unambiguous alarm about a direct and immediate threat: hostile regulatory action emerging from Washington, D.C., while the Clarity Act represents a looming broad-spectrum uncertainty. The specific policy threat highlighted is more acute and targeted: legislative efforts to ban stablecoins from paying interest. This is not a distant macroeconomic concern. It is a proposed rule change that could surgically dismantle a core value proposition of the decentralized finance DeFi ecosystem. The anatomy of the threat stablecoins, particularly those like USDCT or USDT, are the lifeblood of the DeFi economy. They provide a stable unit of account and medium of exchange within a volatile crypto market, enabling lending, borrowing, and trading. The ability for users to earn yield on these stablecoins by lending them out in liquidity pools or through lending protocols is the fundamental engine that attracts capital to DeFi. It is the interest rate mechanism of this new open financial system. A ban on interest-bearing stablecoins is therefore not a minor compliance adjustment. As the script powerfully analogizes, it is akin to banning cars from going faster than horses. It is a regulation designed not to manage risk or protect consumers in good faith, but to artificially cap the utility and competitiveness of a new technology to protect the incumbent banking system. Its intent is to ensure that decentralized protocols cannot offer a superior financial product, a yield-bearing digital dollar, compared to traditional bank savings accounts, which currently offer negligible interest. The immediate cascading impact, the consequences of such a ban, would be severe and rapid. Capital flight. The primary incentive for holding stablecoins on-chain would vanish. Billions in capital would likely exit DeFi protocols and potentially the crypto ecosystem entirely, seeking yield elsewhere. Protocol insolvency risk, major lending, and yield. Generating protocols, which depend on the supply-demand dynamics of stablecoins, could face liquidity crises or collapse as their core business model becomes illegal. Stifled innovation. It would establish a precedent that the most useful and innovative applications of blockchain in finance are subject to preemptive prohibition, chilling all development in the sector. The broken promise and the political imperative. This threat is framed within a broader political failure, the broken promise of regulatory clarity. The script notes that legislative solutions were promised by key political figures but have failed to materialize, leaving the industry in a dangerous limbo. This vacuum is now being filled with piecemeal hostile proposals rather than constructive frameworks. The conclusion is a call to action. The script implies that the industry is no longer in a phase of passive waiting. The response must be active political engagement. The image of industry leaders getting on their private jets and flying to D.C. underscores the urgency. This is a lobbying battle, a fight for survival that must be waged in the halls of Congress, not just on blockchain networks. Strategic implication for the market for investors. This represents a unique and paramount risk. It is non-diversifiable, systemic political risk. No technical analysis, cycle theory, or macroeconomic forecast can mitigate it. The entire valuation of the DeFi sector, and by extension, a significant portion of the crypto ecosystem's utility and attractiveness, is held hostage to this political outcome. Therefore, the single most important macro indicator for crypto in the near term may not be the consumer price index, or Fed meeting minutes, but the markup language in a congressional subcommittee. The market must now price in a new variable, the probability of a regulatory attack that seeks not to regulate, but to cripple a foundational pillar of its economy. Until this threat is neutralized through political victory or legislative compromise, it will act as a powerful overhang, potentially negating any positive catalysts from other fronts. The fight for the future of open finance has moved from the digital frontier to the heart of political power.